Welcome back. Thank you for joining me again. In the last few lectures, we've been talking about this notion that in efficient markets, security prices reflect all currently available information, and that prices change quickly to reflect new information. Well, one way to assess whether that is indeed the case is to look at how security prices change around a particular event of interest, basically through what we call an event study. So in this lecture, you're going to learn about a powerful technique used in empirical finance research to assess the impact of a particular event on security prices. For example, you might be interested in knowing how a particular announcement, say dividend changes, the announcement of a dividend change, impacts returns. Why would that be useful? Well, if you could, for example, predict a future change in a company's dividend policy, then knowing how the stock price will react or is expected to react to that information can help you trade accordingly. Now, of course, this is easier said than done, right? Because prices move in response to a wide range of economic news every minute, every day, and identifying and isolating the part that is just due to that particular announcement is not an easy exercise. So to assess the impact of a particular event on a stock price, what we really want to measure is the unexpected or the abnormal return, right? In other words, the difference between the actual return and what we might have expected otherwise. So how do we do that? Well, one way to do that might be to think of returns as being determined by a market factor, just like in CAPM, as we saw in the previous course, plus some idiosyncratic firm-specific factor, right? So, for example, we could write down, right, what we call an index model and decompose the return into a market and a firm-specific component, right? So, suppose this is the return, right, on a security. We could write an index model as A, B times the market return plus some idiosyncratic return factor, right? So the T is the time, right? So here, RMT is the market's rate of return, right? What is B? Well, B is the sensitivity of that stock to the market return, and E, right, is the part of the return that is firm specific, right? So if we can estimate what we could ordinarily expect for a given level of market performance, right, then we could subtract that from the actual return and isolate the part that is firm specific, right? In other words, right, if we can estimate these parameters, we could subtract the actual return from the actual return, all right, and that will give us the firm-specific factor, right? So basically, this is the general idea of an event study, right? The idea is to estimate the abnormal return around the date when new information is first released to the market, right? So for example, this could be the date of an announcement, right? So typically then, the first step would be to estimate the index model, right, such as this one, to estimate the parameters, then identify the date of interest, right, compute the abnormal return surrounding or around the state, right, and assess the magnitude of the typical abnormal return to determine the impact of the announcement, right? So in fact, we looked at such an event study for mergers in one of the previous lectures, right? So you might remember this picture from before. The authors of this study were interested in knowing stock price reaction to takeover announcements, right? And remember, as I mentioned before, the announcement of a takeover is good news for the firm because typically shareholders get paid a premium for their shares, right? So the announcement of a takeover attempt should cause the stock price to jump, right? So what you see in this graph, on the x-axis, you have the dates relative to the announcement date, right? The announcement date is marked as 0. And on the y-axis, you have the cumulative abnormal return, right? Which is simply the sum of the abnormal returns over this period, right? We estimated the parameters and computed the abnormal return. And what you see is, right, you see a large positive abnormal return, right, on day 0, on the announcement date, right? So this is consistent with the efficient market hypothesis, right, that once the news becomes public, the price jumps. Okay, so in this lecture, you learn about event studies. Event study methodology is very widely used. It's a tool to measure the impact of a wide range of events on security prices. So for example, the SEC regularly uses event studies to measure the illegal gains by traders who may have violated insider trading or some other securities laws. So this is one application of the event study methodology.